right. Welcome to another episode of Asset Coach and Tax Strategist. Welcome. I'm so excited that you're here. Hey, if you're a subscriber, thanks so much for subscribing and for being part of our community. Slow growing, but I love it. I love that we're growing. Again, I do this because it's fun. It supports a lot of my thought process, my methodology, really following the guidelines of the book I wrote called Economic Termites and Farming Assets. You can find the links down below if you're interested in reading them. They're extremely long, about 130 pages long. Quick read, very, very simple. If you've watched any of my episodes, I write like I speak, so dumb. Just kidding. And so Economic Termites, what are they? Kind of what's this content that we do on Asset Coach Tax Strategist is really about termites. We know what termites are, right? Termites, when we find out we have a termite problem, the damage has already been done. And so economically, we have economic termites. And what are those? There's four major ones. Taxes. So we talk about taxes quite a bit. Inflation. We talk about inflation quite a bit. Time. And this doesn't become a specific topic. There's not a lot of articles written on time, but how taxes, inflation, how the laws and regulations, the kind of the queen termite, are politicians, how those decisions that politicians make affect our taxes, inflation, and the time that's associated with that. Right. So when there's like in 2008, early 2000, when we have economic downturns, we go into recessions, it usually takes the stock market, if it drops by 30 to 50%, it usually takes it about 5 years to recover to break even. That's time. And if you were planning on retiring in that period of time, you have a lot of money, all your retirement sitting there. Again, this is not an investment advice. This is education information only. Then you got an issue and you have to make up that time. Right. So here is one of those articles, one of the things that we talk about that helps the time, but this is not going to talk about taxes. This episode's not going to talk about inflation. This episode's not going to talk about our laws and regulations. This episode's going to be more about farming assets. And somebody I really respect, I don't believe in his personal politics. I think his personal politics have really kind of fall more into libertarianism versus Democrat, but he believes more on the Democrat side. But I think that's just because of his party has left him and he hasn't left them yet. He's rooted in his ways. And the gentleman I'm talking about is the fifth wealthiest person in the world, Warren Buffett. He has laid a foundation. He has laid a groundwork. He has laid this process for how to really how to build wealth. And let's look at this. So I'm gonna bring this over here. I'm gonna share my screen, and then we're gonna dive into Warren Buffett and Berkshire Hathaway. But let's see, wealthiest people in, we'll just say the U.S. He's in the wealthiest in the world, but cities. Sorry. So this will be interesting because I want to point out something that is interesting when we look at this list. Okay, let's just do Wikipedia, just really easier as we dive in there. So Elon Musk, okay, Tesla and SpaceX, right? He made his billions in PayPal initially. Jeff Bezos, Amazon. Mark Zuckerberg, Meta. Larry Ellison, Oracle. All kind of one-hit ponies except for Elon Musk, right? Now, Amazon, at the end of the day, they have hundreds of companies underneath them. We get that. But the one who really built this, look at here, we got Larry Page, Alphabet, Sergey Brin, Steve Ballmer, Bill Gates, Bloomberg, right? These are all singular. What did Warren Buffett that was different than everybody else? He built Berkshire Hathaway as almost like a mutual fund where he buys multiple, it's a conglomerate. Where's the next conglomerate in this, right? That's the beauty of what he has done in Berkshire Hathaway. And so I highly respect what he's done in Berkshire Hathaway, and I've done other episodes. And let's see here, subsidiaries. Let's go to subsidiaries. So insurance, big part of his business. Railroad, he bought in 2008, BNSF, energy and utilities, manufacturing, and then services and retailing. Okay, so all of these companies he owns outright. Now, he invests in these companies: American Express, Bank of America, Moody's Rating, Chubb Limited, Citigroup, Visa, MasterCard, Capital One, Aon, Newbank, Ally Financial. Then that's all in finance and insurance, and in manufacturing. Notice how he invests. Very diversified. Very now, let me create this caveat here. I am not giving investment advice here. Okay. This is for educational purposes only. This content that we're going to be talking about is literally just to give you information and a pathway to go down your own. I'm not telling you that this is a good fit. Again, not investment advice. Okay. But how to build your own Berkshire Hathaway style holding company. This is beautiful. This is let me tell you how much we believe in this. This is what we're doing at Terra Firma. This is what we do for our members. Okay, so if you're watching this and you're deciding if, and you're a physician and you're deciding if, hey, do I want to hire these guys? And you went on our other YouTube channel, Wealth Mavericks, where we talk content specifically to you as a physician, or you're trying to figure out more about me, my methodology, what's all this mean? Here it is. Here it is. Asset allocation, diversification, recession-proof industries, companies, right? And we look at things that provide good, healthy tax benefits as well. Okay, where does the government give us the best tax benefits, and where they encourage us to put our money to get those tax benefits? Okay, so what I did here, because this is small and I don't like all these videos and all this kind of stuff. They're very distracting. I cut and paste into a Word document. Okay. And so we're gonna go ahead and go through and read through this. This is Robert Doherty. This was written in February 6th. Okay. And this is Forbes. Okay. Articles on Forbes. So there you go. Props. Robert. Forbes, props. There we go. Let's dive into this. Warren Buffett's investment strategy: build your own Berkshire Hathaway. What if you could build your own version of Berkshire Hathaway? Not its vast scale, but its proven approach. Owning exceptional businesses for decades at a time when high frequency trading dominates market volume and the average holding period has collapsed to months, if not weeks. This approach might appear outdated. Yet the market's most successful investor, now, by the way, we all see him as an investor. Warren Buffett is a master of capital. That should be his title, not most successful investor, not the Oracle of Omaha, master of capital. Man, that has such a great ring to it. Why do I say that? Because the dude knows how to get capital to be productive. You and I are used to working day to day, trading our time for dollars, whether it's on our own business or whether it's as an employee. We put time and energy into what we do and we get $1 in return. That's human capital. Warren Buffett has done an amazing job of taking that dollar that he has earned, that you and I earn, and getting that capital to work just as hard as we did to earn that initial capital. So he values capital earned and deployment of capital to earn capital. And it is a hamster wheel. It is an ecosystem. It is a synergy to build wealth. It's been laid out for 6 decades. The dude didn't just decide this, but his method of how to access capital, how to use capital, and how to grow capital makes him a master of capital. All right. So hopefully that gets to Warren. Warren, there you go. You're welcome. Would love to meet you one day. But from Warren Buffett to Henry Singleton to Ken Fisher have built lasting fortunes by investing. So those are some other guys. Now, while many investors often opt for index funds in the traditional 60-40 portfolio split and a proven approach that has served millions well until it doesn't, a more ambitious strategy exists for those prepared to think differently about value and time. Prepared to think differently about value and time. Love it. Love it. Beautiful. Beautiful. Just as Buffett did when building Berkshire Hathaway. The cornerstone, understanding intrinsic value. The foundation of enduring investment success lies in grasping intrinsic value. Okay. What a business is truly worth based on its future cash flows. What's cash flows? Capital. He's creating capital. In order to create cash flow, you have to have capital to create cash flow that creates capital. So this begins with fundamental questions. Will this company's competitive advantage endure for decades? Will consumers remain loyal to its product and service? And as Buffett famously notes, you want businesses so simple that even an idiot can run them. Amen. Amen. Because eventually one will. So Warren Buffett understands that the moment a creator, a entrepreneur exits out of their business. So I started a business in a garage. It grew, it grew, it grew. It's a public company. It's very successful. At some point, you're going to exit out of that business, and somebody who did not blood, sweat, and tears that business to success will run it. That's what he's saying. And some will be good, some won't. And you want a business that can survive just that. The good, and more importantly, the bad. Okay? Peter Lynch's observation that people often invest more times researching toaster oven purchases than stock investment remains painfully relevant. This is so true. His maxim, know what you own and why you own it, isn't just wisdom, it's the prerequisite for building serious wealth. All right, let's highlight that. Now you see why I respect Warren Buffett so much. This is just the very basics, the mathematics of concentrated return. So Charlie Munger, who just passed away, was his partner for decades. 2 peas in a pod. I mean, amazing. Now, Charlie Munger's insight that the first rule of compounding is to never interrupt it unnecessarily. Compounding of what? Wealth, growth, compounding the business. The first rule of compounding is to never interrupt it unnecessarily. And by unnecessarily, what he's meaning is that know what the heck you're buying. Because if you know it and it meets all those other requirements, you don't need to interrupt it. Let it roll. Doesn't mean every year is going to be like a party and we did great. There's going to be some bumps. Those bumps allow for a business to thrive. Okay. All right. Most investment fortunes spring from a handful of exceptional performers held for decades. The real challenge isn't identifying these rare companies, but maintaining the conviction to hold them through market turbulence and negative headlines. All right. The overlooked edge. Time. Ha! Ha ha! What did I say is the economic termite? Time. What's the overlooked edge? Time. Markets typically price in events on 3-month or 3-year horizons, creating a systematic blind spot for patient investors willing to think in decades. Consider Coca-Cola, one of Buffett's signature investments. Its value wasn't created through precision timing, but through holding the business through decades of global expansion and evolving customer tastes. Now, here's the interesting thing about Coca-Cola. Today, I don't think Warren Buffett would buy Coca-Cola. But when he bought them, he also earns significant dividend income from his holdings in Coca-Cola. Cash flow. So by holding it, buying it when it was younger, buying it when it was growing, when it was evolving and expanding, now it's a household name, pays out dividends, it creates more cash flow. So he earned the appreciation, and now he's earning the cash flow, capital, right? The architect your investment vehicle. Building a Buffett-style portfolio demands a fundamental shift in perspective. First, approach stocks as partial ownership of real businesses. Be business-minded. This is what we tell all of our members, everybody that comes to us. We're going to treat you as a business because you are a business. And we need to make business decisions, not emotional decisions. Okay? And business decisions support your emotions. And if you vehemently disagree with something emotionally, logically, somebody's wrong. If I got a great investment, if I got a great business that makes so much sense, but you don't believe in it or you don't emotionally like it, that's not going to be a good fit, even though it's a great business. Okay? But you also have to reflect on yourself. Am I a fool for feeling this way? Do I need to reflect and change the way I feel to see if I can not take advantage, but be rewarded with this purchase? Okay? Very important. And that's what the beginning, what I was talking about. Know what you own and why you own it. Very simple. But if it's an emotion, right? So the most compelling opportunities often emerge in companies where founders maintain significant ownership stakes, ensuring their interests align with long-term shareholders. The second, focus exclusively on businesses you can thoroughly understand. Okay? This is important. If you can't explain the company's competitive advantage and business model in a single paragraph, move on to simpler terrain. And this was Warren Buffett's thing about tech stocks. He just didn't understand them. Not that he's dumb. They were a different business model. And it wasn't a business model that he was completely 100% comfortable with until he was. And then what'd he do? Bought big time in it. But he didn't just buy these no-namers, these small companies. No. He followed his discipline. So he bought into Apple. Third, maintain and concentrate portfolio of your highest conviction ideas. Okay. While diversification protects against ignorance, concentration prepared with deep understanding builds transformative wealth. This is so important. Warren Buffett says that diversifications for those who are basically stupid. And they say it here, diversification protects against ignorance. Okay. But if you do your homework, all's good. You did well. So I think this is vital. Fourth, think in decades rather than quarters. Short-term market movements are noise. Long-term business performance is signal. So very, very important. A lot of noise. So if you're watching, CNBC or Squawk Talk or whatever all those shows are, you're going to be emotionally driven. You're going to be emotionally driven by these. And you're going to make changes. Deal in reality. Deal with what is. Fifth, maintain substantial cash reserves. This is huge for Buffett. Patient investors need dry powder to act decisively when exceptional opportunities arise. Okay, so cash reserves. These didn't say cash savings. So Grant Cardone used this, and I heard this in one of his video clips that I just loved. He said, "People who save money is ridiculous. You should store cash, not save cash, because when you store cash, exactly here, you can actually take advantage." Opportunities that arise by just saving cash. You allow taxes, inflation, time to deteriorate that wealth. Cash is best when it's productive, when it's moving, when it's going. It's like a bicycle. Who just sits on a bike and just sits there? It's not what it was designed for. That's a chair. What was a bike designed for? To move. That's cash. That's capitalism. Cash is best when it's moving, when it's flowing. So this is why I call Warren Buffett master of cash, master of capital, because he is looking to take cash he has, invest in a business that generates cash. Then he takes that cash, buys a business that creates cash. I have repeated myself, and I'm doing that purposely. You need to understand the simplicity of the brilliance. Okay. Now, success in this approach demands measures of what matters. Rather than fixating on quarterly benchmarks, focus on streams of cash flow. Focus on streams of cash flow your business generate and the strength of their competitive positions. That's why he looks for companies that are in the top of their industry. Okay. Then he looks at other competitors to outweigh the financials. He doesn't always buy the most top of the company. He'll buy the company that makes the most sense for his cash to create cash. Are they investing capital at high stakes of high rates of return? Is their market position still strong? The elegance of this strategy lies in its simplicity on the far side of complexity. While it demands more upfront work to understand business deeply, it offers something rare in investing, a substantial edge that grows stronger as markets become more short-term focused. In the end, you're not trying to beat the market every quarter. You're building generational wealth through ownership in exceptional businesses. Okay? There we go. This game, patience, isn't just a virtue, it's the greatest competitive advantage. And Warren Buffett has proven that decade over decade over decade over decade. Okay. And this is why he has investments in all these companies and ownership in all of these, and why he is so smart when it comes to capital. Look at this. Net income, 8.5 billion. In 2024, 88.9 billion. Total assets, 1.1 trillion. He employs 392,000 people in all of his companies. This, my friends, is why I respect Warren Buffett. Now, the most impressive part is how he uses the insurance part of his business, the capital in the insurance business, to create wealth and cash flow in his other businesses. So go check out my episode talking about insurance float, Warren Buffett and insurance float. And this is the secret sauce. This is the secret sauce. So if you haven't subscribed, hit the subscribe button. Give us a thumbs up for this content. I'm going to be honest with you. This is probably one of my best episodes. Bar is really set low. So, but I appreciate you investing your time with us. Great to see you, or great for you to see me, for me to see you virtually and in the metadata. So go make it a great day. Thank you so much.